Hello and welcome to Williams Mullins Benefits Companion, a podcast that helps employers navigate the complex legal challenges of managing their employee benefit plans. I'm your host, Bryden DeWitt, and today I'm delighted to be joined by a new guest to our podcast, Sarah Parker, Director of Retirement Plan Consulting at Sageview Advisory Group. Welcome to the Benefits Companion, Sarah.
Thank you for having me, Bryden.
So, Sarah, we were at a conference a few weeks ago, and I learned that you are an expert, or you've done a deep dive into private markets and the investment in private markets by defined contribution plans. Traditionally, 401k plan participants have only had access to publicly traded investments, but that's beginning to change. We've had the executive order from the Trump administration. Private markets are moving more into the conversation for defined contribution investments. And so I thought it'd be really great for our listeners to hear from you with your expertise in this area. So let's start with just the basics, Sarah. When we talk about private markets, what exactly does that encompass?
Yeah, thank you. That's a great first question. I do think the asset class is a bit misunderstood. So when we say alternatives, really what we're talking about is anything that's not a traditional stock or bond investment. And that is further then segmented into alternative assets and then alternative strategies. So what I mean by that is alternative assets are things that are real estate, commodities, gold, right? The strategies, alternative strategies, are things like private equity, hedge funds, where you're actually paying a manager for their skill. Now, of course, you can kind of overlap a little bit. Obviously, you might need some skill in private real estate, but those are essentially the high level categories that then there are many numerous sub asset classes. But what has happened with the private market discussion in 401k plans is that we're starting to change from saying alternatives to private markets, because really the products that are coming out are in fact really fourfold: private equity, private credit, private infrastructure, and then private real estate. So you're kind of getting a combination of the strategies and the assets. And the reason for the kind of sub asset class differentiations is because they all have different reasons for adding them to a portfolio.
So what's driving this renewed interest into private markets among defined contribution plan sponsors?
Well, I think really the primary reason it's being driven is a lot of these large investment shops have figured out how to offer them inside of a 401k plan. They figured out how to meet the daily liquidity needs. And so now that it's been structured in a way to meet those daily redemptions, for example, they've kind of come to market with some creative strategies. And that certainly was one of the primary reasons. I think that the secondary reason is kind of the excitement around giving participants something that's different. You know, if you look at a lot of 401k plans, the largest investment is probably going to be a target date sweep, and the second largest is probably going to be an S&P 500 fund. And that's been the case for some time now. So
Right.
I think the other part of what's driving this is advisors are excited about it, right? This is a whole new area of the investment world that we haven't been able to highlight or showcase or even talk about. And there's a lot of opportunity there.
So it's not just what we're hearing from the Trump administration, but it's really the structure and availability of these types of investments for 401k plans is really coming into focus, it sounds like.
Correct. Yes, I think a lot of advisors have, a lot of my peers and colleagues maybe are cautious, about some of the concerns around the structure, obviously, because this is new, right? It hasn't really been done by many plans yet. But there is there's a significant amount of forward thinkers in this space where they are very much excited about the prospect of allowing participants that have never had access to these really unique investment deals. And they're excited to present those and tell those stories.
Okay, so given this backdrop of what's happening in the marketplace and what we think we're going to see with Department of Labor regulations and maybe a safe harbor in this area, if you are a plan investment committee and you really are interested in offering these types of investments, what are the primary hurdles to incorporating private market investments within a 401k structure?
Yeah, that's a great question. So, well, there's a lot of things to take into consideration, but I think one of the biggest hurdles is going to be your advisory staff and who you're looking to for investment advice. It's going to be important to make sure that you have advisors on your team that know this space and know how to analyze and what questions to ask these private investment managers. And also what to ask the target date suites or the managed account advisors that are selecting these private markets. I think a second really big concern is around obviously the liquidity, making sure that you truly understand how that works. Are they creating a CIT sleeve that is essentially a money market? How much is that going to be on hand? Is it going to be a 20% target to cash? And kind of make sure you understand that process because that could be a drag on performance. I think another really big hurdle that you're going to have to overcome is understanding that the terminology in this space is a little different. I mentioned forward thinking. You really are going to have to think a little bit differently about these types of investments. It's not necessarily about historical performance on a 20-year period and what was the standard deviation. It's more about what's the experience with these teams? What have they done in the past? What deals have they been involved in? What's been their history and their tenure in the private space? And so it's been a little bit more about qualitative analytics than quantitative. And then, I think a really a big hurdle is going to be the fees. I guess that'd be the last one I'd comment on. Fees here, it's more expensive. It's more expensive in the private markets. You're looking at management fees, but then also performance fees. And so having an understanding of how that works is going to be really important. And also working with your advisory firm on negotiating that investment fee. The advisors that have the size and scale are going to be able to help you negotiate those fees down versus just kind of taking what's publicly available and what you can see, because the fees can be pretty high. So understanding those and making sure that you get how a performance fee works is going to be very important.
Yeah, you make a really good point about having advisors that understand this area.
Mhm.
Like, ERISA holds fiduciaries to a prudent expert standard of care, which means plan fiduciaries have to make these decisions as though they are experts on private markets and on alternative investments. And plan fiduciaries rely on their advisors to provide that expert advice to meet that standard. And this is really a new area for 401k plans and defined contribution plans. So
Mhm.
it's important, if you're going to go down this path, that you realize that you need to have advice from someone who understands this new area. Are there other fiduciary considerations that a plan fiduciary should have when exploring these types of investments?
Yeah, I think that the due diligence done here is going to be very important, keeping that in your files. You really want to see the due diligence done on these investment options and that the investment team that's backing your advisor or the advisor itself, you want to make sure you've got a pretty decent file, maybe a little thicker than for some of the mutual funds you have. I think you also want to have a really good handle on what's coming out of the Department of Labor. I know we are still waiting for some guidance there, but as a fiduciary, I would want to make sure that my advisor, if I was sitting on the plan sponsor side, was following any guidance that was issued and that comes out. We're not expecting anything till maybe February at this time, but that's going to be very important to make sure that that's being followed. And then I would say fiduciaries are going to be at risk of not considering private markets. I think even if it's not for you, right, and it's not something that you want to pursue, I think having the discussion is going to be extremely important for a fiduciary. Asking about it, exploring it, even just high level understanding what the asset classes are is going to be a fiduciary responsibility because they are becoming very important and a big topic in this industry.
Yeah, that's a realization I've been coming to, is that it may be a fiduciary problem if you don't consider them,
Right.
and given the potential returns.
Right, and consideration could mean just simply education, right? Let's at least learn about what these asset classes are and what they would do for the participants if we added them to the target date suite, and not necessarily looking at individual products. So I think
Right.
just having a discussion around what they are and why they're gaining popularity is going to be important.
But I think until we have a Department of Labor safe harbor or some other guidance under the Biden administration, there was guidance that really warned, against cryptocurrency and private equity. And if you read that guidance, it's not really partisan. It's just kind of the facts. Like there are reasons that these are difficult types of investments for defined contribution plans, for ERISA plans, given the lack of the normal methods of valuing the investment and the transparency and a lot of the uncertainty involved with things like cryptocurrency. And so until we receive a safe harbor or additional guidance that tells us that we can invest in those types of alternative investments, that prior guidance, even though it's been rescinded, I think is, pretty good guidance to rely on until we get something else. So if, it's kind of, I think these things need to be considered, and it's good to have committees, getting up to speed and learning about it. But until we have more guidance from the Department of Labor, I'd be really cautious
Right. Agreed.
still about investing. This has been a great conversation. If there's one key takeaway that you want to leave the listeners, what would that be?
Yeah, I would say, I heard someone told me the other day, well, there's no demand from plan sponsors for private markets. So why would we even be putting these on agendas and talking to committees about private markets? And I said, well, did they demand target date funds? Did they demand managed accounts?
Right.
It's on the advisory community to act as investment advisors and to bring the best ideas to our committees. And even if it's decided that this is too different, we don't understand this, we don't want to move forward, that's fine. But it's our responsibility to bring the ideas to the committees and advance the thinking, especially around investments. So even though this might not be an appropriate path for a lot of plan sponsors and a lot of committees, I think it's important to just have the dialogue. And so I think that's the last thing I'd leave you with is you should start talking about it.
Okay, that's good advice. Well, Sarah, thank you so much for
Yeah,
coming
thank
on to
you.
the Benefits Companion.
I appreciate being invited. Thank you.
So that wraps up this episode of the Benefits Companion. If listeners have any questions or suggestions for future episodes, please contact me. You can also visit our employee benefits page at williamsmullen.com/employee benefits. There you can find out more about our team, as well as past episodes of this podcast and legal alerts. Finally, be sure to subscribe to this podcast to be notified when our next episode posts. Thanks for listening.
This podcast contains general condensed summaries of actual legal matters, statutes, and opinions for information purposes. It is not meant to be and should not be construed as legal advice. Individuals with particular needs on specific issues should retain our services or the services of other competent counsel.